All right, so everyone, I hope everybody is having a wonderful day. Today we are going to start talking about the top 5 things that you have to be aware of before the end of this year, before December 31st, and of course the top 5 things to be prepared for 2016. So welcome, my name is Shauna. I am more commonly known as the Tax Goddess, and I am thrilled to be here to help you guys today roam through all of these crazy tax laws. So hopefully we will have some awesome conversation. Want to bring up that in the bottom left-hand corner of your screen, there should be a Q&A box. So I will be going over all questions at the end of the presentation today. So if you have any questions whatsoever, go ahead and put them in that Q&A box, and then we will get to them at the end of the slides. So, all right, let's get started. And what we're going to do, here's me, your presenter. So Shauna Weckerling, Tax Goddess, CPA with a master's in tax, and a certified tax coach. And I'm one out of 4 certified tax coaches here in Arizona and one of 500 in the US. So definitely my specialty is creating tax strategies for small businesses to try and help them minimize their tax bill as best as we possibly can. So today, what we're going to start with are the 5 things that you need to know before the end of the year. Obamacare has been on everybody's minds and tongues for the past 2 years. So one of the main things that you have to be aware of before the end of this year is that all small employers that provide certain types of self-employed health care arrangements may have to file some of these new forms. Originally, the conversation was that if you had 50 employees or less, you might be exempt from this, but at the moment, as of today, you are not exempt. Most insurance carriers will be able to cover this for you. So if you're a business owner and you have any kind of health insurance, health care, any kind of medical arrangements whatsoever with your company, please ensure that you're checking with your health care insurance provider if they are going to be preparing these forms for you, or if you're going to be required to do so. The IRS has really hit hard on people not filing forms. They're increasing penalties very, very heavily on this, and especially because this relates to the new Obamacare rules, they are really going to be going after businesses that don't have their ducks in a row. So if you have any questions on this, make sure you reach out to us, or of course your healthcare insurance provider, to make sure who is going to be doing this for you. There are certain situations where, whether you're a big employer, you know, that more than 50, you have even more strict rules. So if you are out there in our crowd today and you have more than 50 employees, definitely check with your providers, make sure that you're good. With relation to a health reimbursement arrangement, these are really, it's really healthcare expenses where the company is agreeing to reimburse employees up to a certain dollar amount. Now note that this is not a medical expense reimbursement plan. This is not a MERP. They are 2 separate types of accounts. HRAs, a health reimbursement arrangement, has basically been announced to not be allowed. They are looking at these very, very closely, and if you don't, again, have your ducks in a row and are doing this in the correct manner, there are some pretty serious penalties, up to $500 for each form that is not properly filed. So make sure, one more time, 3rd time's a charm, check with your insurance carriers and with your CPA to ensure that you have the right forms being filed. All of these forms are really coming in the form, the number of the form is a 1095. You'll see a 1095A, B, C. So if you see any of the 1095 form requirements are for you, something to watch out for. Healthcare issues continued. So these rules are extremely technical. One of the major issues that you can run into is if you're providing some sort of healthcare plan that does not meet the ACA, the Obamacare requirements, there is a penalty, more penalties, $100 per day for each employee that is covered under a non-proper plan. So please double check, triple check, quadruple check to make sure that these are the correct plans. You're meeting all the requirements under the ACA. And again, if you have any questions, reach out. Second point here, employer payment plans. We were looking at whether or not the employers could cover expenses for certain types of shareholders or employees. So for any of you that have S corporations out here, if the S corporation is reimbursing or paying the premiums for the S corporation owner, more than a 2% owner, these payments are required to be properly reported on your W-2. Last year, 2014 and previous, the IRS started talking about this. We were really hit heavy in 2014 that this was a serious requirement. They wanted it done. 2015, they're now going to start penalizing you per day. So, if you could imagine $36,000 of penalty for a year if you're not doing this properly. So please ensure that you're checking, especially if you're an S Corp owner, to ensure that this is being done correctly. Number 2, top 5 before the end of the year, depreciation. Every year since 2009, Congress and the Senate and the government have passed these extender laws. And it basically has said that if you purchased equipment up to certain dollar limits, that you're allowed to write it off all in the first year. Now, those extender laws expired at the end, at December 31st of 2014. As of yesterday writing this, they still have not been extended for 2015. Now, the interesting part here is that last year, the IRS extended it on December 19th. So if you've already bought equipment this year, your maximum cap under today's rules is $25,000 for that equipment in the current year as a 179 depreciation deduction. Anything above that would be at the normal life and class for that type of property. So 5-year property, 7-year property, 15-year property. Honestly, the government has been extending this rule, as I said, since 2009. So the expectation from the experts is that, yes, it will be extended again this year, but certainly don't plan on it. And of course, don't make any tax decisions until we know. Here at Tax Goddess, we are keeping up and watching those tax laws every day as they come across from the government. So if we hear anything different, we will be sending that out in our newsletter. So of course, make sure you're subscribed so you know the latest details. First place where you're looking at buying an auto, there are some special depreciations for auto. Maximum in calendar year 2015 is basically $3,000. It used to be that you could get $25,000, $50,000, the full purchase of a truck or an auto. At this point, only heavy SUVs, trucks that are dually wheeled trucks, if used more than 50% for business, will qualify for that $25,000. So if you're in the construction industry, or you're buying the huge Cadillacs that are more than the SUV Cadillacs that are more than 6,000 pounds gross vehicle weight, you will be able to qualify for that 25. But you want to be really careful. A lot of people, if they're purchasing a new car, make sure that you get the sticker that tells you how many pounds gross vehicle weight, and for many people that includes adding a tow package to meet that 6,000 pounds. So make sure you're checking how many pounds if you purchased a new vehicle this year. De minimis rules. This has really changed. It's been a huge uproar. 2014 was the first year that this was really brought up, but 2015, they've just about 2 weeks ago released a new set of data. So in 2014, what was happening is that you would have to look at all purchases, even something as small as office supplies, to determine whether it was de minimis, meaning small enough that it wasn't applicable to your business. The original rule in 2014 was that if the purchase was more than $500, it automatically became capitalized and you would have to depreciate it over time. The IRS, as I said 2 weeks ago, has now raised that to be $2,500, so $2,500 for any kind of de minimis item. So for example, under the old rule, if you were to purchase a new desk and the desk cost $800, you would have to capitalize that. Under the new rule, the $800 falls below the $2,500, you do not have to capitalize that. There was quite a bit of hubbub on the 2014 returns. The IRS trying to clear up asset lists, make sure everything was following the new rules. One of the major issues that we have seen for clients that were not with Tax Goddess is the failure to file the elections. This de minimis safe harbor is actually an election that you have to file every single year on your tax return to effectively inform the IRS, yes, we've agreed, we want to follow the new rules, we want to be good taxpayers and do what we're supposed to do. The second piece of this is that you want to make sure that you actually have a document in writing with your safe harbor dollar limits, whether it's the $2,500 or $5,000. And by the way, all these slides will go out with all this data to everybody, so you can definitely read more or ask questions. The $5,000 limit is for people that have applicable financial statements. So normally these are much larger companies that have audited or reviewed financial statements. But for most of our clients, what you're looking at is having a written statement that talks about the $2,500 de minimis. If you need a template, our office will have that available probably at the end of this week. So feel free to send us an email, and we are happy to send you a template under the new rules to make sure that you're up to code. So point number 4, penalties. Yes, the IRS is in fact broke. So exciting. Unfortunately, so is the Arizona Department of Revenue, which means that they are out looking for ways to get more money out of our taxpayers. Now, with the IRS, the biggest issue, and it's been happening for the past 20 years, they are looking for little tiny ways to get their foot in the door to either audit you or get these penalties hooked out of you. One of the most common ways, one of the easiest ways for them to get their foot in the door is regarding the 1099. So we talked about the 1095s. This is the 1099 forms. It's always been a point of contention, you know, who do we need to prepare 1099s for? 1099s are related to contractors or people that your business or you personally pay money to do a job or work for you. In the past, the failure to file a 1099 penalty was $50. Last year, it increased to $100. This year, it increased to $500 per form. So you'll notice that the penalty is split into 2 pieces here. You have a penalty for failing to file the proper form, and a penalty for failure to include the name of the person who the form is going to. So what this really means, it's a lot of technical jargon, what that really means for my business owners, for all of our business owners out there, you have to get W-9 forms on file ASAP for anyone that you paid money to more than $600 in the 2015 year. This is really, as I said, a way for the IRS to kind of get into your business, grab some major penalties if they find anyone that was supposed to get a 1099 and did not. So if you have any questions on who should receive a 1099, you know, if you're over or under, where should you be filing, those kinds of things, please, again, reach out to our office. The IRS does have huge amounts of publications on their website as well at irs.gov, but we are more than happy to give you a recap in those arenas. With 2016, now you'll notice here at the very bottom of the slide, the $500 penalty, the effective date for this is 1/31/16, but it's really effective for any files, any returns that are due after December 31st. So when you talk about 1099s, the 2015 1099s are due January 31st of 16, which means these penalties apply for the 2015 1099s. So again, you know, we've had a lot of cases in the past where, yeah, you know, I paid this plumber and I paid him $700 and so close to the $600 and it's only a $50 penalty and maybe the IRS won't even see it, that kind of thing. That's becoming very, very risky business. Please make sure that you're getting the W-9 forms from anybody that you're paying so that you can properly file your 1099 forms. Yeah, talk about that. So the Arizona credits, I am a huge fan of the Arizona credits. This is one of the few free money loopholes in the tax code. So this is absolutely something, if you owe tax to the state of Arizona, I highly recommend you to do these credits. And especially if you itemize also at the federal level, these credits will actually give you money back. It's free money. So with Arizona, you are obtaining a dollar for dollar credit, which means that any money that you put into any of these credits, and I've just noticed, I'm sorry, I want to make an on-the-fly correction here. The public school credit, the maximum is $400 joint. I'm so sorry, we will correct that in the slides before they go out. But dollar for dollar, you're obtaining a credit for money that you put to a private school, public school, a foster care charity, or either a working poor credit or the Military Arizona Relief Fund. So dollar for dollar, if you owe Arizona tax, this will redirect your Arizona tax dollars to these charities. You will get $1 off of your Arizona bill. And at the federal level, if you are in the 20% federal tax bracket, for the total amount of contributions you make here, if you itemize, you have a 20% tax bracket, you will also get 20% off your federal tax bill, which means you're actually making money at the federal level. So Arizona credits, we absolutely love. They are great, free money, definitely a big proponent of them. And if anybody needs a place to donate, on our website at taxgoddess.com, under the client menu, there's a drop-down page that talks about all of the links for the Arizona school credits, for the public care, for the foster care, and the working poor credit. Please note that this does only work if you file an Arizona tax return. Every state has their own credits, so at the moment we are only talking about the Arizona returns. We've got a few bonus items, other things that I thought were important. So some updates as far as retirement plans. Last day to prepare and file and create a 401k, which is one of the largest contributory type retirement plans, is December 31st. So if you need to create a 401k, now's the time to get on it. You know, with Christmas and the holidays, we want to make sure that everybody has time to get that set up. And secondly, there are some new maximum limits. We've gone up from $17,500 to $18,000 if you're under the age of 50. And if you're over the age of 50, the additional catch-up contribution on top of the $18,000 has gone up to $6,000. So the total amount that you can put away is $24,000 in a single year if you are over the age of 50. FSA limits as well have increased a whole of $50. The other thing that is really nice about the FSA that they put into place is that now you can roll over $500 worth of your FSA funds to the next year. FSA in the past has always been a use it or lose it kind of adventure. So if you didn't spend all your money by the end of the year, that money was just gone. So you would always see people running out to Costco to buy, you know, contact lens solution or a new pair of glasses or whatever, Band-Aids. But now the IRS has changed that, so you do have a $500 rollover, and you get that extra $50 that you can contribute to that type of account. The extenders, we kind of talked about the depreciation options. These are all of the rules that you see on this slide. These are all of the rules that are going to be kaputs. They were kaputs as of December 31st, 2014. But these are the ones that are expected to extend. These are the ones that have been extended year after year after year. And generally, middle of December, so hopefully here in a couple of weeks, we will hear whether or not these are going to be extended for the 2015 year again. So you've got a 50% first year bonus depreciation. For example, if you bought a piece of equipment that was a $20,000 piece of equipment, you'd get $10,000 of depreciation right off the bat. And secondly, you'd have the expanded 179 deduction up to $250,000 instead of our maximum cap of $25,000. Some of the other details here, the most important one really for a lot of our clients is the research and development credit. That credit is a huge tax break, dollar for dollar, credit throws dollar for dollar. So if you're doing any kind of research or development of new product, new software, new medical aids or drugs, those kinds of things can give you huge tax credits. All right. Planning alerts, you know, this is our the main two tax brackets, or I'm sorry, the main two tax deductions that have the broadest impact. We talked about the 168K deduction, the 50%, and the expanded 179. So top new rules, are there any questions? Remember, if you have any questions, please put them in the Q&A in the bottom left. So we're moving on now to the new rules for 2016. This one is a huge one for business owners, and at the moment it is still proposed, but I wanted to make sure to get this information out there. It's extremely important for business owners. The government is proposing to change the overtime rules. In the past, you were only automatically guaranteed overtime if you've logged 40 hours and you earn less than $23,660 a year. So for many companies, the overtime rules didn't apply. There's also some exempt types of categories, and we'll get to those here in a minute. But really the proposal is that the new minimum wage for overtime is going to be almost doubled to $50,440 a year. If that occurs, the government is estimating that that is going to put about $1.3 billion into the workers' pockets. So out of, if everything stays the same, out of the company's pockets into the workers' pockets. So if you're a business owner, you really want to pay attention to this overtime rule. Is that going to impact you? How is that going to affect you? And how do you potentially want to either change your business or change your business model to be able to either pay the overtime, not pay the overtime, whatever your decision is. In the slides, there are really lots and lots of details. I'm sorry the print is so small. I was trying to get you guys lots of information. So I really foresaw that there would be 4 potential changes with this overtime rule. Step 1, you potentially are going to start paying overtime. If that minimum raises and you have employees that are less than that minimum and you don't do anything to change, you will start paying overtime. Employees will get a raise. What we are seeing in some cases, and what some of our employers are talking about doing, is giving their employees a raise so that they'll just surpass the threshold and therefore will not obtain overtime. Nothing illegal. It's just a choice by the business owner. What we will see here is another option: no more pay, but hours could be limited. So if you're not meeting that 40 hours, business owners might say, okay, we're going to cut you at 39.5 to keep you under the overtime rules. Or, of course, you're not going to see any changes in hour or pay, but maybe eligibility for other types of programs, other types of benefits. What you do see is sometimes exempt or non-exempt, whether this is going to apply to you or not apply to you as far as overtime. Companies will change the benefits that one group will obtain or not obtain depending on whether they have the overtime, to try and make things a little more fair between the classes of exempt or non-exempt. So if you have any questions or concerns about how this overtime rule may impact your business, you want to work through some scenarios, definitely reach out to us. We're more than happy to help. All right, white-collar exemptions. This is the one thing that I wanted to make sure to bring up to you. There are 3 main exempt categories for this rule, and that is if someone is in the administrative field, if they're in the executive field, or if they're in the professional field. So lawyers, CPAs, administrative assistants, CFOs, vice presidents, that kind of thing. Moving on to number 2, this is the year we're really going to see, we come back to Obamacare, back to the ACA, the Affordable Care Act. This is the year we're really going to see penalties starting to hit people who do not have their health insurance. With the health insurance now, if you don't have a proper ACA health insurance policy, you will get hit. Mandatory penalty has been increased to 2% of your yearly household income, or $325 per person in your household, maximum of $975. So unfortunately, it's the higher of the 2, not the lower of the 2. So if you are unsure about whether or not you are going to obtain an ACA approved policy or not, this would be a cost that you want to factor into your decision to either obtain proper coverage or improper coverage according to the ACA rules. Okay. Supreme Court ruling. So now every state is required to recognize same-sex marriages. Either marriage. It's completely regardless of gender. The main impact that that's going to have is that now married couples of both kinds, of course, will or can file joint income tax returns. They can do property transfers to each other tax-free, and can leave an estate to a spouse without gift tax implications, as well as the benefits of inherited IRAs. So really the biggest thing that we're seeing here, you know, good or bad, no matter which gender, married filing joint still has a penalty to it. You know, so being married is more expensive than being single, but the major benefits here is, of course, being able to transfer property back and forth without tax, as well as the leaving of the estate. So number 4, new deadlines. So this is probably my favorite rule for this upcoming year. We are observing Emancipation Day on April 15th this year. So everybody is going to get 3 days to not pay their taxes and not pay their first estimates. You get 3 days tax-free. Instead of April 15th, your taxes and your tax returns will be due on April 18th. Of course, if you're in Maine and Massachusetts, you will also have until April 19th, so you get 4 days tax-free until Patriots, because Patriots Day is on April 18th. So if anybody has any questions on the deadline change, let us know. These deadline changes do not impact the extension deadlines, so your personal returns will still be due October 15th of 2016 for the 2015 year. Arizona being rated number 6 best for property tax. I thought this was very exciting. Unfortunately, our ranking is not so great in some of these other areas, but for property tax, we are ranked number 6. One of the reasons why I bring this up, 6 being really high on the list, one of the reasons why I bring this up is that what you want to do, if you haven't done it already, is take a look at how much you're paying for property tax and whether or not you should file for either an exemption or a review. You are allowed to file for a review of your property tax. Your property tax here in Arizona is based on the value, perceived value by the state of your property. And in many cases, those values are still very high, way back from when the market was high. There was some adjustments about 3 or 4 years ago, and they've slowly been creeping back up again. But if you have the time, this could be a way to drop your tax bill, overall tax bill, by anywhere between $1,000 to $2,000, depending on the cost of your property taxes. So certainly something to look at. Tax brackets. I wanted you guys to have the new tax brackets for 2016. You can see that the maximum amount here is 39.6. Now, please understand that this is just the income tax bracket. As you guys have seen over the past 3 or 4 years, there are a lot of new little sneaky taxes that are being added on to your income depending on how much income you are actually earning. There's a 0.9% additional Medicare tax. There's some additional investment and earning taxes. There's the very nasty alternative minimum tax. So one of the things that you want to look at, kind of guesstimate if you haven't already done any of your winter projections, look at where you think your income is going to come in, your taxable income is going to come in, and are there any changes according to our webinars today or any other opportunities that you may be missing before the end of the year. So if you have any questions on that, we do have about 2 weeks to really get any kind of serious tax planning done. So if you have any questions, definitely reach out to us for sure. Lifetime exclusions. The annual gift tax exclusion has not changed from last year. Last year it was $14,000. It's going to stay the same for this year. They've been bumping it up by about $500 every other year. So next year I would assume that it's going to go up to about $14,500. Really, the biggest question that we always get about this is, okay, so I want to gift some money to my children. Can I just write them a check for $14,000? Yes, you can. However, that is another little hook for the IRS to get into you, because the question is, so really you didn't give your kids any Christmas presents, any birthday presents, you didn't buy them a single thing all year. So if you're in a gifting program, we always recommend that if you're going to gift cash, you gift at least $1,000 or $2,000 below the annual gift limit so that you don't get into trouble for over gifting. And of course, the estate exemption is being raised, not a ton, $200,000. The major bump was a couple of years ago when we went from $1.2 million up to the $5 million range. And really what this relates to is that if you were to pass away today, what is the value of your estate? Anything lower than this number would not be taxable, only in very specific certain circumstances. So if you have any questions about the estate tax, definitely reach out to us. Standard deduction, there is a very slight bump. We went up by about $100 per person, so that will be very handy for some people. Of course, it's still $100 at your tax bracket, so if you're in the 20% tax bracket, that's going to be $20 off your return. Better than nothing. So after all these little sneaky taxes they're adding in there, we definitely are happy to have something. So additional items, we've got the education credits. The maximum credits are going up a little bit, so we're up to now 2,500 instead of what used to be 2,000, so that's gone up. But again, with a lot of these education credits, you really have to watch down to the very bottom line. Your modified adjusted gross income will determine whether or not you even qualify to take the credits. Any income above these limits and the credits will be off limit for you. This is probably the scariest one, and I'm sorry I left it for last, but I didn't want to scare anybody off. One of the major tax planning strategies that has been in place for, well, basically since 1986 is the creation of an S corporation in order to only pay self-employment tax on the income that flows through to the owner as W-2 wages. This has been an extremely popular tax planning strategy. They are proposing to now tax all of the income, whether it comes across as W-2 or K-1 distribution draw income. They're proposing to tax all of the income with self-employment tax. Now, in many cases, especially for our clients here at Tax Goddess, our recommendation was always to have your W-2 wages at about 40 to 50% of your total profit for the company, therefore leaving 60% of that income as non-taxable to the self-employment tax. If this proposition passes, and they are looking at it right now, that we should know by the end of the year, if this proposition passes, this will be a massive tax hit to a lot of small business owners. The CPA communities, myself included, are out there fighting to make sure the government knows that if they pass this, they're probably going to put some businesses out of business. And at least my own opinion, the small business owner is the one that's backbone of the country. We're creating all the jobs. So CPA community is definitely fighting on your guys' behalf to try and ensure that this does not happen. But the proposal's been on the table for a couple of years. It's been turned down a couple of years. It's starting to get more and more likely that this will occur. What that really means for all the small business owners out there is that if you are currently an S Corp and this guy passes, you want to jump on strategic tax planning ASAP. We need to figure out other ways to reduce your tax bills so that this 15.3% additional tax, 15.3% additional tax will not have as big of an impact on you as it potentially could be. And the IRS is ranging that this additional income will be in the billions to the government for this. So they're certainly, as we mentioned before, government's broke. They're looking for ways to get their money. Right now, I'm ready to head into questions. So I see we have some awesome questions down here in our Q&A. So I'll start with the one here from Christina. So can someone donate to a public school, private school, and foster care fund in the same year and get dollar for dollar tax credits for all three? Yes, Christina, that is correct. Actually, there are 4 credits that you can donate to all 4 of them in the same year. And as long as you have Arizona income tax that you're paying, those dollars will offset your Arizona income tax. So that would be the public school, the private school, the foster care fund, and either a charity that helps the working poor or the Arizona Military Fund. So, and those limits, we will send those limits out along with the slides, and this presentation will always be up for rewatching later, or you can always email me to get direct instructions from our website. Affordable Care Act from Gwen. Aren't there exemptions for grandfathered health plans? There are. The ACA, the Affordable Care Act, the Obamacare has definitely been changing rules on a day-to-day basis at this point. So I am not an expert in the ACA, definitely an expert on the tax side, but we do have experts in the ACA that we can reach out to and get that answer for you. So if you would like to email me your question, Shauna, SHAUNA @taxgoddess.com, be more than happy to find that answer for you. I do believe that there are still a very slight few grandfathered plans, but not that many anymore. So John has a question. If my state tax liability is less than the amount of tax credit, may I still donate and get the credit? Excellent question, John. Thank you so much for asking. Yes, you can. So what will happen, let's say your state tax liability is $2,000 and you make the maximum across all 4 credits of the donation, which I believe is around $3,200. The difference of that $2,200 difference will roll over to next year's taxes. Now note that those rollover credits are only good for 5 years. So at some point, if you expect that you're going to owe tax in the next 5 years, you can go ahead, make the donations now, and have those credits apply to future years' tax bills. Cindy, we have a great question here from Cindy. So does the person that you gift the money to have to pay tax on the gift? So the way that the gift tax works is that as long as the gift is below that $14,000 limit, then there is no gift tax at all. The person receiving it doesn't have to pay any tax. The person paying it does not get a deduction either. So literally it's just you're moving money from one person or moving an asset from one person to another person. If the gift goes above the $14,000, so let's say you give somebody a $20,000 car, there is again no tax to pay on that, but what it does do, there's a specialty form that you are required to file, and it's called a gift tax report, gift tax form, and what you're telling the government is, okay, I gave somebody $20,000 of my lifetime estate exclusion, that $5.4 million, will be reduced by the $20,000 gift that you gave. So really what a lot of my parents will do, and please remember that the $14,000 is per person. So if you're married, you know, if you're husband and wife and you have one child, you could really give up to $28,000 a year to that one child based on, you know, $14,000 from the mother and $14,000 from the father. So wonderful. Well, if there's any other questions, I'll hang out here for another couple of minutes, and if anybody has any questions, please feel free to put them in the Q&A section. And of course, my contact information is up on the screen. Once again, I'm Shauna the Tax Goddess, a CPA with a Master's in Taxation, certified tax coach. And it's definitely tax planning season. So now is the time to make any changes that you could possibly need for the 2015 year before the year is out. So I want to say thank you so much for everybody attending today. I'm happy I could get you in and out pretty quick, hopefully get everybody back to their super busy days. We have another question here from Cindy. We pay taxes for the $14,000 though, right? No, if you've already paid tax on the $14,000, you know, it's your money and you're going to gift it to somebody, they don't also have to pay tax on the $14,000. You paid it. So I hope that clarifies the question. If it doesn't, feel free to email me. We will chat about it. So another couple quick other questions from Lawrence. Will the recording be available on your website approximately? Well, yes. Thank you, Larry. Great question. Yes, today's webinar, the slides, the information will all be recorded. I understand that will be up and done by the end of next week. If that comes up any sooner, we will announce that in our corporate newsletter. And of course, you can always check our website and our YouTube channel under Shauna Weckerling on YouTube and see most of our videos. So, all right. Well, if there's no other questions, I want to say thank you so much and have a wonderful day, everyone.